We're going to calculate the stock price for Rogers Communications. And the first thing we need is the market cap, which is 29.3 billion. And the stock price 57.70. So to figure out the shares outstanding, you just take the market cap divided by the stock price, and that gives you 508 million shares outstanding. Next is free cash flow. And the best way to calculate the value of a company is to estimate future free cash flow and discount that back to today's dollars. That's exactly what we're doing in the video. Okay, and next we need net income, which is the profit and loss for a given year. And we use 4 years of financial data. And revenue is last. And now that we have all the inputs, we need to figure out the capital structure of this company so we know what to discount the cash flows by. So let's get the interest expense. That's the interest on the debt. That's 800 million. And to figure out how much debt they have, let's go to the balance sheet. In the liabilities section, we need the current debt and the non-current debt. So the current debt is 2.2 billion and the long-term debt is 16 billion. So they pay 4.39% on their debt, but debt is tax deductible, so the interest payments are. So we need to figure out the effective tax rate. So the income before tax is 2.8 billion and the income tax is 700 million. So the effective tax rate is 26%. So when we discount the interest payment, the cost of debt is 3.25%. Now we need the cost of equity, and we just can pull the beta. That's a really low beta, 0.28. That's one of the lowest I've seen. So the equity is 4.47. We use a CAPM model to figure that out. And the cost of debt is 3.25%. And when you blend those together, you get 4%. And that's the weighted average cost of capital. That's what we're going to discount the future cash flows by. So we calculated future cash flows for 4 years, and we did a terminal value, which is all the years after year 4. And when we discount that back to today's dollars, we get a value of the company of $58 billion. And when you divide that by 508 million shares, you get a stock price of $115, even though it's trading at $58. So this is considered a buy. It's trading at half of intrinsic value. So it is harder to value smaller companies and companies that don't have consistent earnings. So you do have to make some assumptions, and you'll see some analysts saying that this stock is a buy. Other analysts say this stock's a sell. But each analyst uses their own model and their own assumptions, but you never see their model. This is my model and my opinion. So thanks for watching.